Hello friends, welcome to Finance MCQ. So friends, in this series of lectures, we are covering important MCQs for your upcoming NHPC Senior Accountant Exam. This is lecture number 23 and today we will be covering some important MCQs from standard costing topic. So let's start the video. So friends, the first question is, which is the primary purpose of setting standards cost? So option A, to determine the actual cost of a product after it is manufactured. Option B, to simplify the process of inventory valuation for tax purposes. Option C, to comply with the requirements of financial accounting standards. Option D, to provide a benchmark for measuring and controlling performance. So friends, what are standards? Standards are basically that level which are used to compare with the existing performance. So the correct answer has to be option D, which says to provide a benchmark for measuring and controlling performance. So friends, this is the core function of standard costing, to establish a target against which actual performance can be compared.
Friends, before moving on to the next question, I would like to inform at Finance MCQ, we are offering NHPC Senior Accountant Exam course. The course covers the entire technical syllabus, that is 140 marks out of 200 marks. An entire course is having subject-wise, topic-wise MCQs, including past exams questions from other PSUs of similar nature. And this course also include NHPC previous year exam papers, which will be helpful for your exam preparation. So do avail this opportunity. Visit Finance MCQ website, take a demo of NHPC course and start your preparation. Further friend, you can use coupon code NHSA100 to get flat 100 rupees off on the course price. So now let's move to the next question.
Friends, next question, an unfavorable or adverse variance indicates that actual costs are lower than the standard cost. Option B, actual costs are higher than the standard cost. Option C, actual revenue is higher than the standard revenue. Option D, the standard set were too easy to achieve. So friends, here we are speaking about unfavorable or adverse variance. So this has to be bad for the company. So the correct answer has to be option B, which says actual costs are higher than the standard cost. So the explanation is, an adverse or unfavorable variance occurs when the actual cost incurred is more than the planned standard cost. Moving on, friends, next question. Material price variance is calculated as option A, standard quantity minus actual quantity into standard price. Option B, standard price minus actual price into standard quantity. Option C, standard price minus actual price into actual quantity. Option D, standard cost minus actual cost into actual output. So friends, pause the video, think over it and let me know the correct answer. Friends, here the correct answer is option C, standard price minus actual price into actual quantity. So friends, this correctly isolates the effect of paying a different price than the standard for the actual quantity of material purchased or used. So friends, one task for you here, let me know the formula for material usage variance in the comment box. Moving on, which department is typically held responsible for a material usage or quantity variance? Option A, production department. Option B, purchasing department. Option C, sales department. Option D, finance department. So, what should be the correct answer here, friends? It has to be option A, production department. So friends, the production department controls how materials are used, so they are responsible for variances arising from using more or less material than the standard. Moving on. Friends, next question is, a favorable labor efficiency variance indicates that option A, the actual wage rate paid was lower than the standard rate. Option B, fewer hours were worked than the standard hours allowed for the actual output. Option C, more hours were worked than the standard hours allowed. Option D, the actual output was higher than the budgeted output. So friends, here remember that we are discussing labor efficiency variance. So the correct answer will be option B, fewer hours were worked than the standard hours allowed for the actual output. So this means the workforce was more efficient than planned, completing the work in less time, which is a favorable outcome. Moving on. Friends, next question. An ideal standard is a standard that option A is based on average past performance. Option B is attainable under the best possible conditions with no inefficiencies. Option C includes an allowances for normal spoilage and downtime. Option D is updated on a continuous basis. So, what should be the correct answer here, friends? The correct answer is option B, that says is attainable under the best possible conditions with no inefficiencies. So friends, ideal standard represent perfection that are generally unattainable, which can be demoting for the employees. Moving on, friends, the next question, the total of material price variance and material usage variance is equal to Option A, total material mix variance. Option B, total material yield variance. Option C, total material cost variance. Option D, total manufacturing overhead variance. So what should be the correct answer here, friends? Friends, this is option C, total material cost variance. So friends, the cost variance is the overall difference between standard and actual material cost, which is composed of the price and usage components. Moving on, friends, if the actual price of material is higher than its standard price, the material price variance will be option A favorable, option B adverse, option C 0, and option D cannot be determined. So, quite a straightforward question, friends. The answer has to be option B, which says adverse. So, friends, when the actual price exceeds the standard price, the variance is adverse or unfavorable because it's negatively impacting profit. Moving on, friends, next question. Fixed overhead volume variance arises because option A, the actual fixed overhead cost is different from the budgeted fixed overhead. Option B, the actual level of output produced is different from the budgeted level of output. Option C, the actual number of hours worked is different from the standard hours for actual output. Option D, the price of fixed overhead items has changed. So friends, this is a fixed overhead volume variance. So it has to be related to the volume of output. So the correct answer is option B, which says the actual level of output produced is different from the budgeted level of output. So friends, this variance measures the under or over absorption of fixed overheads due to the actual production volume being different from the budget. Moving on, friends, next question. Which of the following is a possible cause for an adverse labor rate variance? Option A, use of more skilled laborers paid at the higher rate than the standard. Option B, workers completing the job in less time than standard. Option C, poor quality materials causing production delays. And option D, an increase in the standard wage rate. So, friends, which of the following will cause an adverse labor rate variance? Think over it and let me know the correct answer. So, friends, the correct answer is option A, that says use of more skilled workers paid at a higher rate than the standard. Hiring workers who are more skilled than specified in the standard would likely require paying a higher wage, causing an adverse rate variance. Moving on, friends, next question. Standard costing is a key component of option A, financial accounting, option B, management by exception, option C, activity based costing, and last option, cash flow management. So, what should be the correct answer here? Friends, the correct answer is option B, management by exception. So, friends, this is a type of management strategy where manager intervene or rather addresses significant deviations from standards and all routine activities are delegated to others. Moving on. Friends, next question. Sales volume variance is calculated using option A, standard price, option B, standard profit or contribution per unit, option C, actual price, option D, actual cost. So, what should be the correct answer here, friends? The correct answer is option B, standard profit or contribution per unit. Friend, this is the correct method as it measures the impact on profit of selling a different quantity than budgeted. Moving on, company has a standard material cost of 2 kg at rupees 10 per kg for 1 unit. To produce 1000 units, they used 2100 kg, which cost rupees 20,000. So, what is the material usage variance? So, friends, a few questions before I have asked you to let me know the correct formula for material usage variance. So, what is the formula for material usage variance? Friends, it is standard quantity minus actual quantity into standard price. So, friends, here for 1 unit, 2 kg is the standard quantity used. So, here the production is 1000 units. So, standard quantity will be 2 into 1000, that is 2000 kg. So, we are given 2100 kg as the actual quantity and standard price is rupees 10 per kg. So just we'll have to substitute the values in the formula. So that will be, as I said, standard quantity minus actual quantity into standard price. So 2000 minus 2100 into 10, that will be rupees 1000 in negative. So since this is a negative, so the correct answer will be option B, rupees 1000 adverse. Moving on. Friends, next question. The fixed overhead expenditure variance is the difference between option A, budgeted fixed overhead and actual fixed overhead, option B, budgeted fixed overhead and applied fixed overhead, option C, actual fixed overhead and applied fixed overhead, option D, standard hours for actual output and actual hours worked. So, friends, what is the correct answer here? So this is option A, which says budgeted fixed overhead and actual fixed overhead. So friends, this correctly identifies the expenditure variance, which is a straightforward comparison of what was planned to be spent versus what was actually spent. Moving on. Friends, next question. A favorable material price variance could be caused by option A, purchasing materials of a higher quality than the standard. Option B, a general price increase in the market for the material. Option C, skillful negotiation by the purchasing manager or buying in bulk. Option D, less material being used in production than the standard allows. So the question is discussing about favorable material price variance. So, friends, the correct answer is option C, skillful negotiation by the purchasing manager or buying in bulk. So, friends, effective purchasing strategy can secure a price lower than the standard, resulting in a favorable variance. Moving on, friends, next question. When is the material price variance typically isolated for control purposes? Option A at the time of material purchase, option B at the time of material issuance to production, option C at the time of production process, and option D at the time of accounting period. So, what should be the correct answer here, friends? Pause the video, think over it, and let me know the correct answer in the comment box. The answer is option A. That says at the time of material purchase. So, friends, isolating the variance at the time of purchase provides the most timely information for control and holds the purchasing department accountable. Moving on, friends, next question. If the labor rate variance is 0 and the labor efficiency variance is adverse, the total labor cost variance will be option A favorable, option B adverse, option C 0, and option D equal to the rate variance. So friends, we all know that the total labor cost variance is summation of labor rate variance and labor efficiency variance. So one part of the formula is 0, other part is adverse. So the answer has to be adverse. So friends, the correct answer will be option B adverse. Since the rate variance is 0, the total labor cost variance will be equal to the adverse efficiency variance. Moving on. Friends, next question. Material mix variance and material yield variance are subdivisions of option A, material price variance, option B, material usage variance, option C, total material cost variance, option D, variable overhead variance. So, what should the correct answer here, friends? It is option B, which says material usage variance. So, friends, when multiple materials are used, the usage variance can be split into a mix variance, effect of changing the material proportions, and a yield variance, effect of getting more or less output from the input. Moving on, friend, next question. A standard cost system can be used with option A, job costing only, option B, process costing only, option C, both job costing and process costing, option D, neither job costing nor process costing. So, obvious answer has to be, friends, option C, both job costing and process costing. So, friends, standards can be set for individual jobs or for continuous processes, making the system flexible enough for both the environments. Moving on. Friends, next question. An investigation of the variance should be conducted if option A, the variance is adverse regardless the amount. Option B, the variance is favorable regardless the amount. Option C, the cost of investigating the variance is expected to be less than the benefit of correcting the problem. Option D, the variance exceeds 10% of the standard cost. So, think over it, friends. Pause the video. The answer is quite logical. It is option C, which says, friends, this cost benefit principle is central to the concept of management by exception. Trivial variances are not worth the effort of investigation. So that's all for today, friends. See you all in tomorrow's lecture where we'll be covering the second part of some important MCQs on standard costing. Till then, thank you very much for watching. Take care and goodbye.